Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we begin, as we usually do, in North America. Hundreds of US companies have rapidly distanced themselves from diversity, equity, and inclusion DEI initiatives following President Donald Trump's renewed campaign against corporate diversity policies. According to an analysis by the UK-based Financial Times, more than 200 major corporations have scrubbed DEI-related references from their annual reports, signaling a significant shift in corporate language and priorities. In the West, DEI has emerged as a controversial movement in business, academia, and government in recent years, fast becoming politicized and a major point of contention in what is colloquially referred to as the culture wars. Proponents of DEI argue that it's a moral and practical necessity. Workplaces and societies thrive when they reflect diverse populations, correct historical inequities, and ensure fair opportunities for all. They say it counters systemic biases like racism, sexism, or classism that they argue still linger. Critics, on the other hand, see it as reverse discrimination, erecting its own structure of systemic biases, as well as a forced ideology. They claim it prioritizes key identity groups over individual merit, potentially lowering standards or alienating talent. Some argue it's divisive, reducing people to categories rather than unifying them, and point to instances where DEI policies have led to resentment, inefficiencies, or have backfired. The tug of war is often reduced to the useful shorthand, equality of opportunity versus equality of outcome. Now, politics and culture are well outside the scope of this channel. What is within the scope, however, is the changing business environment, which is what we're going to be covering here. According to the Financial Times report, among the 400 companies in the S&P 500, 90% that have filed annual reports since Trump's election have reduced or removed DEI mentions entirely. Notably, some have also eliminated workforce diversity statistics and references to DEI-related awards or affinity groups. This corporate retreat is occurring against the backdrop of executive orders signed by the US President in January, which prohibit DEI programs in federal agencies and require government contractors to certify that their inclusion policies comply with federal anti-discrimination laws. The vague wording of these orders have led many companies to err on the side of caution, scaling back diversity programs even if they are legally compliant. High-profile corporations, including MasterCard, Salesforce, S&P Global, Palantir, and American Express, have altered their DEI language between their 2024 and 2025 annual filings. Instead of highlighting DEI, many firms have opted for terms like inclusion and belonging, emphasizing a workplace culture where all employees can succeed. Meanwhile, Morgan Stanley added language stressing merit-based hiring, stating in its latest annual filing that, quote, meritocracy is at the heart of Morgan Stanley's talent development. End quote. The rollback of corporate DEI commitments is not limited to language in reports. DEI-related job postings in the United States have halved since their peak in mid-2022. In some cases, companies have quietly scrapped diversity programs altogether. Deloitte directed staff in its United States government consulting division to remove gender pronouns from email signatures to avoid potential compliance issues. Not all of this is due to the current political or regulatory environment either. Even before Trump's election, some companies had begun reducing DEI language in their filings. Meta, for instance, replaced previous headings such as diversity, equity, and inclusion with more neutral, the strength of our workforce and people processes, suggesting that some companies are making the move not because they feel political or regulatory pressure, but because they're pushing back against an ideology for which they disagree with. Though there are examples of some companies who have taken the opposite position. Costco's shareholders recently voted to maintain the company's diversity policies. While corporate America recalibrates its approach to DEI, the debate over its value, both legally and strategically, as well as morally within the culture wars, continues to intensify in the face of political pressure and shifting regulatory landscapes. Next up, we move to Asia. Indonesia's stock market was forced to halt trading on yesterday for the first time since 2020, after a sharp sell-off saw the Jakarta Stock Exchange Composite Index, IDX Composite, plunge more than 7%. The sudden downturn has reignited concerns over economic stability and investor confidence in Southeast Asia's largest economy. The Indonesia Stock Exchange, IDX, triggered a 30-minute trading suspension in the morning after the index lost 5%, When trading resumed, losses deepened to as much as 7.1% before the market regained some ground later in the session. The sell-off was driven by a combination of factors, including a credit downgrade by Morgan Stanley and speculation over the resignation of the country's finance minister. Tech and manufacturing stocks were hit particularly hard, with data center provider DCI Indonesia plunging 20% and energy and chemical giant Chandra Assi Pacific declining nearly 19%. Investors, both local and international, retreated amid fears of weakening macroeconomic fundamentals. Morgan Stanley's downgrade of Indonesia's MSCI rating from equal weight to underweight was cited as a key trigger for the market downturn. Holsiana Sitomarang, an economist at Bank Danamon, observed, quote, "The currency has weakened by 1.7% year to date, adding further pressure on the stock market. Currency depreciation has amplified capital outflows as investors shift away from riskier assets." End quote. Adding to investor anxiety were persistent rumors that the finance minister was stepping down. Veldi Kurniawan, an analyst at Vintraco Securities, observed on the news, quote, "Her position has been widely viewed as a stabilizing force in economic policy, so any speculation about her departure is a major market concern." End quote. The government, however, was quick to dismiss the claims, with a presidential communications office spokesperson expressing, quote, "The rumors of her resignation are untrue." End quote. Meanwhile, broader economic concerns linger. Inflation has fallen to historic lows due to weakened consumer spending, with government data showing a decline in the country's middle class. As Indonesia approaches the Eid holiday, a peak spending period, soft economic sentiment continues to cloud the consumer sector's outlook. Next up, we move to Europe for our final update for today. But just quickly, if you're getting some value from today's episode of Market Update, don't forget to hit the like button. And if you haven't done so already and you want to be on top of the major updates as they happen around the world, maybe consider subscribing. Thank you so much. And finally for today, the European Union has initiated an investigation into the aluminium market in response to a surge in cheap imports, a move aimed at safeguarding its struggling industry from the knock-on effects of US trade policies. The European Commission is set to announce the probe today, Wednesday. This investigation follows the recent decision by US President Donald Trump to impose 25% tariffs on aluminium imports, a move that the EU fears will exacerbate existing pressure on its domestic producers. The European market has already been grappling with high energy costs, weak demand, and an influx of lower-cost metal from global competitors. The Commission's probe will examine whether Trump's tariffs have triggered a redirection of aluminium exports into the EU market, further eroding local industry competitiveness. If confirmed, Brussels is prepared to introduce countermeasures, including tightening import restrictions and closing loopholes in its steel tariff regime. The EU's aluminium producers have suffered a significant decline in market share over the past decade. Besides Norway and Iceland, which could be exempted due to their membership in the European Economic Area, the primary aluminium exporters to the EU include the United Arab Emirates, Russia, and India. Notably, the EU has already announced plans to phase out Russian aluminium imports by the end of 2026. The new investigation highlights growing concerns that trade barriers elsewhere, particularly in the United States, will divert excess global supply toward Europe, intensifying competition for domestic producers. The EU's investigation underscores the widening global trade conflict sparked by US trade policies. In retaliation, Brussels has already pledged to impose tariffs of up to 26 billion euros worth of US goods. Brussels is also concerned that China's excess steel production, which has suffered from overcapacity for decades now, blocked from the US market by tariffs, could increasingly be redirected to Europe. The EU could become the, quote, main receiving ground for global excess capacities, end quote, as an official EU document put it, in steel, further threatening local producers. To counteract this, the Commission plans to extend existing steel safeguards beyond their scheduled expiry in June 2026. Additionally, it will tighten rules to prevent China from circumventing these measures by exporting through third countries. While Brussels remains committed to shielding its aluminium and steel industries from external pressures, it also faces the challenge of balancing trade policies with its broader environmental and industrial goals. As global trade tensions escalate, whether the EU can protect its industries without triggering further economic retaliation remains to be seen. Indeed, we likely will see further trade retaliation as the global trade war continues to intensify. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Wednesday, and I will see you, hopefully, for one more episode of Market Update later this week.